I think one of the things that it is hopefully teaching us is that when something is misvalued, sometimes it takes a really long time to get back to intrinsic value, but it eventually does. And with gold and silver, well, gold in particular, the intrinsic value is probably $5,000 to $10,000 an ounce. That's based on the analysis that a lot of people have done on what price gold would have to be in order to 40% back the U.S. dollar. In other words, if we went back to a gold standard at the backing that used to prevail during the classical gold standard, we'd need gold to be $10,000 an ounce, which is to say the dollar would then be a name for 1/10,000th of an ounce of gold. And I think that is where we're headed.
John Rubino is a former Wall Street financial analyst who brings expertise to finance and investment. In this video, John Rubino asserts that he anticipates holding on to gold until it reaches $10,000 per ounce, highlighting the favorable position of long-term accumulators. He predicts a potentially parabolic phase, indicating significant potential returns for investors in the current market cycle. Investors drove gold prices to a record high on Friday, the latest surge in a 17% rally so far this year. Over that period, bullion prices have climbed more than twice as fast as the S&P 500. Some experts told ABC News that the price gains stem from a broader trend of investors seeking out high-return assets in anticipation of interest rate cuts expected later this year. In the midst of today's geopolitical turmoil, Rubino observes discussions about European intervention in Ukraine and U.S. actions in Iran, sparking concerns reminiscent of the 1970s crisis. In such scenarios, where currencies might lose value, gold emerges as a preferred asset for preserving wealth. Gold prices have soared past $2,400, reaching a new record high on Friday. This marks the fifth consecutive week of gains for the precious metal, fueled by increasing market demand for safe haven assets amid escalating geopolitical tensions and uncertain global economic conditions. Moreover, Rubino's insights unveil a trend, as central banks are increasingly bolstering their gold reserves in response to mounting geopolitical risks, potentially fueling further increases in demand and prices. Central banks, who have bought historic levels of gold over the past 2 years, continue to be strong buyers in 2024 as well, World Gold Council Global Head of Central Banks Xiao Kai-fan said. These purchases have strengthened gold prices despite high interest rates and a strong dollar. Market watchers told CNBC. Now we present the clips of John Rubino's insights from his recent interview with Palisades Gold Radio. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I think personally, it's got to be $5,000 an ounce where before I start wanting to lighten up at all, and maybe not even then, depending on what's happening in the world. So I think the stackers are in a pretty good place right now because they've been accumulating gold and silver a little at a time for a long time. Average price is way lower than today's price, in gold's case at least. And they're looking at the really sweet part of the cycle now, where even though there could be a correction in between now and then, the last part of this cycle is going to be parabolic. And in which case you make multiples of what you put into your stack. So it's going to be nice to feel smart and see how that plays out. Well, yeah, when you start thinking about safety because you're afraid of what you're seeing out in the world, gold is one of the things that pops up from an investment standpoint because it's basically maintained its value for 3,000 years. And there's a lot of crazy stuff has happened in those 3,000 years, and gold has always been valuable. So yes, money flows into gold and to a lesser extent silver when geopolitics is really unsettled, and it is incredibly unsettled right now. We are not far from World War III. One stupid mistake or one big policy change from here, like for instance, Europe sending soldiers to Ukraine, which they're talking about doing right now. That's the kind of thing, or the U.S. bombing Iran to defend Israel. We've got things that are being discussed out there right now that would start World War III. In which case, it's possible that it doesn't matter what we're invested in because we're all going to be incinerated. But it's also completely possible that World War III is very destabilizing to other parts of the world, and it causes oil prices to go to $150 an ounce and inflation to spike. In other words, we get another version of the 1970s. So we don't all kill each other, but we mess up our monetary systems in a really profound way, in which case gold is exactly what you want to own in that kind of a situation. So yeah, and a big part of the central bank buying, I think, is being driven by these same geopolitical concerns. If you're a central bank in some part of the world where you might be affected by geopolitical turmoil, you might actually be sucked into World War III, who knows? You don't want to own currencies that would be inflated away by the combatants. You want something for your reserve asset that is neutral. It's not making a political statement to own gold. It's just buying something that's going to hold its value over a long period of time. And in a unsettled geopolitical situation, there's more of an incentive to own something like gold than in normal peaceful times. So that could be driving part of the central bank buying that's happening right now. And they're whales. I mean, they're such big players in gold right now that if it's true that they're buying gold in part because they're worried about what's going on in the world, then the fact that geopolitics is getting even scarier might lead to even more gold buying. So that's a real possibility in the next couple of years that we have these whales in the market on top of everything else that really drive precious metals demand. And at that point, they're not really that price sensitive because they want protection. And so you combine central banks who are kind of panic buying gold with momentum traders who are buying it because it's showing up on their momentum charts. And then you get a lot of demand out there in a market that's really not that big. There's not all that much extra gold sitting around to satisfy new demand because there's plenty of gold out there, but a lot of it is in places that you're not going to empty out because gold went up by another $100 an ounce. The central banks who are buying right now are not going to turn around and sell. A lot of the jewelry out there is family heirlooms and has sentimental value, and people aren't just going to bring that into the pawn shop, although some people are doing that now. But a big part of the jewelry in the world is not going to be sold just because gold goes to $2,500 an ounce or something like that.
Regarding China's waning interest in bonds and the potential Fed intervention resembling modern monetary theory, Rubino cautions about inflation and a weakened dollar. A gradual financial disentangling of China and the United States, after decades of symbiosis, may reduce fears of mutually assured financial destruction, but also harden divisions in an increasingly polar global economy. The impact on each party's economy is being scrutinized, but the once feared threat of China's vast U.S. bond holdings appears less formidable. More importantly, China's footprint in the U.S. bond market is a fraction of what it once was. China owns less than 3% of all outstanding treasuries, the smallest share in 22 years, and again substantially down from the record 14% in 2011. In his analysis, JohnRubino discusses the possibility of a currency reset and predicts consequences like a bond bear market and rising interest rates, which could lead to crises starting with countries like Japan and spreading globally. Let's get back to the interview.
Well, that's a really big question because who does buy? For instance, the U.S. is scheduled to issue $10 trillion of treasury paper this year. And somebody has to buy that paper by definition. But who's doing that? Because China is just not happy with dollar hegemony, and they're looking for alternatives. And they're the big Chinese central bank is the big whale in the gold market right now. They're buying a lot of gold, and that's in part that's what's propelling the bull market right now. So you can't really count on China to buy a bunch of treasury bonds, which the proceeds from which we're going to use to build up our military to possibly start World War III with China. It's not in their best interest to do that, is it? And it's not clear who else would be the big buyer of those treasury bonds. So it could end up being the Fed again, which means we could go back to basically MMT, modern monetary theory, where we just create the currency out of thin air and run the government with it. And we have this intermediate step of issuing bonds and the Fed buying the bonds, but it's make-believe, that we're basically financing the government with newly created currency. In which case, that comes back to affect the value of the dollar via inflation. It makes prices go up, the dollar goes down. At the same time, though, that's not a collapse of the dollar scenario because there's so much dollar-denominated debt out there that the demand for dollars to pay the interest on all of those debts that are out there supports the dollar because so many people need it. So there's demand for dollars. There are buyers out there. So the dollar doesn't go away as a reserve currency and a medium of exchange. It just it loses value via inflation, and it gains some competition from other currencies that become useful in trade. Like the BRICS countries are starting to use their own currencies for bilateral trade, and that basically is competition for the dollar. So those are trends that are kind of in place, and they're kind of moving. The dollar is going to get some competition. It's being inflated away, but it's being supported by demand from other sources, and so we've got that kind of set of cross currents that are out there, and they probably add up to the dollar staying around, but there having to be a currency reset at some point where we still have something called the dollar. It's just defined differently, maybe in terms of some other asset like gold. And that's good if you own gold and bad if you trust the government by holding a lot of dollars in bank accounts or in government bond funds, because the value of a government bond, for instance, depends on the value of the currency. So if we're inflating away the dollar, that means we're by definition, making government bonds that are denominated in dollars and pay interest in dollars less valuable. So it's completely possible that we see as part of this process, we see a bond bear market in the U.S., which is the same thing as saying interest rates go up. And that kind of sparks the final crisis, because if interest rates start going up, that means interest costs, spiking though they are, will spike even faster. And you'll see Japan, which is in the worst shape as far as government interest costs potentially goes. We'll see them go first, and then the U.S. will have a crisis, and then Europe will also have a crisis, and it'll be one of those things where the dominoes start knocking each other down. We can't know for sure which goes first, but I would put my money on Japan being the first big crisis in this kind of a scenario.
Gold prices are rising now, giving investors understandable motivation to act quickly. By promptly getting started, investors can ensure that they will be well spent in the days and weeks to come, but they should then monitor the price for opportunities to buy more. How do you perceive the role of gold in your investment strategy amidst the prospect of higher prices and a potential currency reset? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.